In this video, I present you 3 stocks on sale. All 3 stocks look solid from a fundamental point of view regarding long-term earnings growth, and they got much cheaper within the last weeks or months. Which of the stocks is a buying opportunity and which stock better to avoid? My opinion in this video. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. It's all about long-term investing here to profit from long-term capital gains and growing dividends as well. So let's go. First stock on sale is Netco Security Technologies. It's a small cap, market capitalization below $1 billion, $126 million. But it's a very interesting stock anyway, because we have earnings growth, average earnings growth within the last 10 years of close to 25% each year. And we have even an acceleration to 27% within the last 5 years on average, and analysts estimate earnings growth of more than 30% this year. But the stock price dropped. You see it here. You see here the stock price, how it dropped considerably, close to 40% from about close to $40 to a little bit more than $22. The stock, from a fundamental point of view, looks very solid. If we check the last years, the last 10 years, we see this year we have these nice earnings growth. They also started paying dividends, quarterly dividends, and after the first quarterly dividend payments, dividend yield will be based on the current stock price, somewhere close to 1.4%, and I assume dynamic dividend growth as well in the range parallel to earnings growth, which would mean somewhere between 25 to 30%. We also have nice free cash flow here. You see dividends are covered. Balance sheet is rock solid, which means that we have no interest-bearing debt. We have much more, or we have some, but much less. So just 5.7 million interest-bearing debt, and they have cash of more than 10 times. So they are debt-free. They are debt-free because you see that amortization power is going up. They have, which means this amortization power is free cash flow minus dividends, and they could use this money to erase all debt without any problem. 1/4 of amortization power or free cash flow is enough to erase all interest-bearing debt. So it's a very solid balance sheet. What they are doing, they are in the security industry, and they report in 3 segments. First one is door locking services. This is access control. Second one is intrusion and access alarm products, which is alarm systems. And then there's a very, very interesting segment which is called services. And this is software. They write themselves, they develop themselves, and they put the software on the products they are selling, the alarm systems. And with this, they generate recurring revenue with extremely high margins, with gross margins close to 90%, which is much higher than what you can achieve with hardware you do develop, produce, and sell. And this services or software segment is already responsible for more than 1/3 of revenues, and this should increase to 50% according to management. And if you see how fast it increases, from 30% of total revenue just 5 years ago to now more than 1/3, it seems probable or plausible that they can achieve this. This translates into much higher margins. So margins increased in 2012, was still 5%, and now it's more than 3%, 3 times as high, with operating margins of close to 80%. And analysts estimate that margins are still going to grow, which should be possible if the services segment also grows as well. So it's an interesting stock in my point of view, and the business model itself seems to be pretty solid. Question is, why did the stock price drop that considerably? And this has something to do with a mistake in reportings when the last annual report was published, management needed to restate the previous 3 quarters because they made a mistake in the calculation of the cost of goods, and they needed to reduce the net income from 25, close to 26 to 16 million US dollar. And this destroyed confidence of investors and produced this sell-off you see right here. So now the big question is this was a one-time mistake and just limited and everything is fine from now? And if you still would invest your money into a company where something like this just happened? This is the big question. I cannot answer this for you. But what we can do is check it fundamentally and have a look at the business model, which both look solid. What we can do also is to evaluate the stock. And when we do so, we use the reported earnings per share, which they are already restated. So this is already with lower net income. The last available estimate here from one analyst seems to be very optimistic. We skip it, and then we still have the next or the current and the next business year for our anime estimates to get an idea about the expected yield. But first, let's find out if the stock is over or undervalued. We do it like this, and then we can also make it logarithmic. You see it a little bit better then. And what we see is that the stock was overvalued for a very long time, starting 2019 till very recently. It was considerably overvalued. Fair value based on the last business year was close to 24 US dollar, but stock price was between 35, 36, something like this. Let's zoom in a little and we see it better. It was 33. The stock price increased close to 40 US dollar before it started dropping, and now it dropped back to the fair value thanks to this sell-off and the expected yield. If we just use these metrics out of the box, which means that the average price earnings was 32, current price earnings is 30, which is a little bit lower than the average. And if you just use this, we get an expected yield of 36.4% annually, which is a little bit more than the earnings growth. And I do not change the matrix here. I make no adjustments. I could make adjustments, but I don't do so, because I think if you have an earnings growth of about 30%, then price earnings of about 30 is absolutely justified. But you could do could be more prudent, carefully in your evaluation, and you could make some adjustments here. I don't do it. So there's an annual yield of 36%, which is mostly due to the profit growth of the company, which is about 30%, and then a little bit more because the stock is slightly undervalued right now, and then it has potential of additional capital gains, like a little turbo. This is NAPCO Security Technologies. I have another stock for you, which is much more popular or well known, and this is called Dollar General. Dollar General is a dollar store, so everything you buy there is really cheap. But it doesn't mean that it's valuable, but it's cheap. And we see here, when we also take let's take the adjusted earnings here, and then we see here a considerable stock drop in the price as well. Let's see here, come on, let the dividend go away. So now it works. So we lost about close to 2/3. The stock price went down 63.7%, or close to 2/3. And we have a current price earnings ratio of 10.8. And on the average, it was about 18. So the stock is much cheaper right now than it has been in the past. So where's the problem? The problem can be seen when we make some fundamental analysis here. So we have not only sluggish earnings growth, but earnings decline, which is due to margin decline. Operating margins considerably decline from more than 10% to right now 8%, and they should decline even further. And of course, the stock market anticipates this and sends the stock price down. Dollar General, they sell cheap stuff, and they are cheap in any way after everything you are reading. So the stores are more or less in bad condition, can be dirty. The working conditions are bad. The wages are bad. People earn about $12 1 hour compared to Walmart, where you earn better. $2 you get more on average on Walmart. And the problem I see here is that Dollar General should better focus on the existing stores and on the working conditions and improve these. But what management is doing is they want, still in this business here, to open 1,000 new stores. So they try to expand at any cost. The question is if this is the good strategy, if you already have some problems, just to make the problems bigger by creating new stores, which basically maybe have the same problems as the old ones, and the old ones don't get fixed. We also have a balance sheet which is much weaker than the balance sheet of the previous company, NAPCO Security Technologies. So you see that the amortization power is negative, which means that dividends are not covered. You can also see it here with the free cash flow. The free cash flow is in free fall here, and dividends are not covered anymore. We also have operating cash flow dropping considerably. So this is the problem. Interestingly, they make share repurchases, and they still accelerated share repurchases management in the last years, 22, 23. And then the stock price, although the stock price dropped, so they were, from a current point of view, burning money with this, although they have already a weak balance sheet. So I see it a little bit critical what they are doing right now, and they have strong concurrence with Walmart, Target, and our dollar stores. They are the biggest dollar store, but I'm a little bit skeptical about management, what they are doing. Anyway, let's make the valuation of the stock, because out of the box it looks really cheap. So let's see it here, and let's zoom in, and then we see here that the stock was overvalued for a long time. Also here it was always a change between under and overvalue and fair valuation, but starting from 2019 to 22, stock was overvalued. And now, because of this considerable drop in stock price, stock costs right now $160, and the fair value, although the earnings went down, is still $142 based on average of 18, a multiple of 18. Now I would say, because the problem is obvious of Dollar General, that we should adjust this price, fair price earnings down, not to base ourselves completely on the average of the last 10 years, which we could also change, but manually make it drop. I would say you could now argue, and this is stock valuation is a little bit like an art. It's no exact science. I would say this is a little bit of a turnaround story here in Dollar General, because if they don't solve their problems, it will get worse and worse each year. So I would say, let's say that the stock market priced in already the current price, the current problems, and the current stock price is really the fair value of the stock. And then we had this the fair value of the stock right now, this $105, which corresponds to the stock price. And then there's a problem that analysts estimate that the earnings go down at least within the next months. And because of this, I think the stock market already anticipated this. So this means I would slightly increase the fair value again. I want the fair value to match the current stock price, but the fair value of the current business year, which means we'll play a little bit, and we are very, very close now. For me, it's okay. So our assumption now is that the stock is really fairly valued because the stock market incorporated in the stock price the current problems. And now we can calculate the expected yield based on what analysts estimate right now. And then the annual yield would be close to 9%. Here you see the capital gains and here you see the dividends. Close to 9% is slightly above what the market offers you on average on return for to place your money or to put your money into a turnaround story. And for me, this is no attractive risk-reward ratio. So for me, Dollar General looks cheap, but is not a buy. Maybe the third stock is a buy. The third stock is in the same segment, retail, like Dollar General, but a little bit better quality. It's called Target. Target, the stock price also dropped considerably. And when we make the adjusted earnings, you see what stock price dropped here from 261 to 110. It's also considerably. So you lost more than half of your money if you watch this. And the price earnings are higher. They are now 15, and you see that they are close to the average, although the stock price dropped. This can only be the case if the stock was considerably overvalued before. You see it here that the stock was overvalued before, and the stock price went up, because Target was profiting from Corona lockdowns because they had no lockdown because they were selling food stuff, and when the people were in the shops, then they were already also buying other things like electronics, for example. So Walmart is selling a lot of stuff. You can see it here. Food and beverage made their day during lockdowns, but now we have a sluggish economy. People are not buying that much anymore. They get no Corona-related checks. And what's not going very well is electronics. Beauty and households not going very well. Apparel and accessories is not going very well. Home furnishings and decor is not going very well. Then they had this unfortunate, fashion release of this, you know what I mean, huh? And so some things come together. But for me, it's not a general problem, like with Dollar General, that the shops are in bad condition and working conditions are so bad. For me, it's more it looks like a headwind which is more or less seasonal, and it will pass. So for me, Target is more interesting. You could also make here the quality check, and then you see that what is interesting from earnings point of view, everything looks okay, but we also see here that the free cash flow got negative, but it is already recovering. The free cash flow does not cover all the dividends right now, but it's expected to go up again. This is due to increasing inventory, in my point of view, in the first run. And let's check if this. And it's because of also like with Dollar General forced share buybacks here, so which made the free cash flow negative. But the situation is already improving. I don't expect a dividend cut for them. Their situation regarding balance sheet is also better compared to Dollar General. You see here that they have cash of 1.6 billion US dollar. They pay dividends of close to 2 billion US dollars. They are not covered for 1 year. They are covered for about 3 quarters. So I'm still optimistic that they don't need to cut dividends. We also have more optimistic analyst estimates that showing that not only free cash flow and margins will go up. If we look at, and this could be a nice or an interesting dividend stock, I suppose, because Target has a dividend yield of close to 4%, and these 4% are much more than you got within the last time dividend yield was already as low as 1%, and now it's 3%. Sorry, target, no, dividend yield close to 4%. Yeah, it's close to 4%. I looked at the wrong number, close to 4%, and before it was really low as 1%. So nearly 4 times higher dividend yield than just about 2 years ago. And we see that Target's dividend yield was also even higher in 2017. And if you bought the stock here, you made nice profits. Let's evaluate, make a fair value calculation for this one as well. And here we see that the stock is close to fairly valued right now. Stock price $110, fair value based on last 4 quarters $112. And I think that here I make no adjustments. Price earnings of 15, in my point of view, is okay. Is even cheap if analysts' estimates become true, and we will have earnings growth of 25, 19, and 11% respectively. And then we can expect annual yield of 18.4%, which is double as much as Dollar General. And this is not that much a turnaround story than Dollar General is, in my point of view. So this stock looks more attractive. So I think NAPCO Securities looks attractive to me. Target looks attractive to me. Dollar General does not. This is my conclusion. Of course, I would be happy if you give your conclusion and write them down in the comments, and I would also like to discuss a little bit with you. Also tell me if you think that I missed an important point. And if you want me to analyze another stock, then you can also put it down, your wish, in the comment. Thanks for watching. I'll see you next time. Bye bye.